Welcome to Breaking News to Trading Moves. Today we're looking at the market reaction following that recent OPEC Plus decision. The main news is that OPEC Plus approved a very small output increase for December. But the key part, they're signaling a pause on increases for the first quarter of next year, Q1. So our focus today is figuring out the immediate market consequences based on the analysis, who stands to gain from this, and who's facing pressure.
Yeah, it's really about understanding the strategy here. It's quite deliberate. That tiny December increase, that seems like a nod towards maybe regaining a little market share, but the Q1 pause, that's the real message.
To avoid flooding the market, presumably.
Exactly. They're trying to prevent an oversupply situation that could really tank prices. It looks like they're prioritizing, market control over chasing the highest possible price right now. They seem willing to trade maybe some peak cash flow in the short term for more stability, aiming for crude in the low to mid-60s perhaps, assuming, of course, global demand holds up.
Okay, so that stability focus immediately sets up a bit of a conflict, doesn't it? If downstream users save money, someone upstream might be missing out. Let's start with the winners then. The groups that might benefit from crude prices not spiking higher, first on the list seems to be the major U.S. airlines.
Makes sense.
If crude prices have a ceiling, that directly helps with their biggest variable cost. Jet fuel. That must give them better visibility for planning, right? Especially with holiday and spring travel coming up.
Absolutely. Better visibility means they can manage fares and profitability more effectively. The analysis highlights Delta Airlines, that's DAL, United Airlines, UAL, and American Airlines, AAL, as companies likely seeing some relief.
Okay, moving from the airlines, what about U.S. refiners?
Well, stable feedstock pricing, that's crude oil, is really good for them. It helps support their refining margins, what the industry calls crack spreads.
Crack spreads. Can you quickly explain that for us? Why does stable crude help, say, Valero?
Sure. The crack spread is essentially the refiner's profit margin. It's the difference between what they sell the finished products for gasoline, diesel, jet fuel, and what they paid for the crude oil input. So if that input cost, the crude price, is stable or moderate and demand for their product stays decent, that spread, that margin, tends to widen. And that's good for their bottom line.
Got it.
And with product inventories already pretty ample, this stability really underpins those margins, especially if travel stays strong and distillate cracks the margins on diesel and the like remain firm.
And the tickers mentioned there?
Right. The analysis pointed to Valero Energy, VLO, Marathon Petroleum, MPC, and Phillips 66, PSX.
Okay, and one more category on the winning side, chemicals and plastics manufacturers.
Yeah, their benefit is pretty direct. Lower costs for their hydrocarbon inputs.
Things like ethane and naphtha.
Exactly. Those costs are often linked to crude prices, so when crude stabilizes or eases, their input costs can soften too.
Oh, you go.
That provides some support for their processing spreads in commodity chemicals.
And the companies highlighted.
Dow, ticker DOW, LyondellBasell Industries, LYB, and Westlake, WLK.
All right, so airlines, refiners, chemical companies potentially feeling some relief. Now let's look at the other side. If prices are somewhat capped, who feels the pressure?
Right, the flip side. That limited upside puts pressure squarely on the production side, the ones who really need higher spot prices to maximize returns. The first group feeling this are the explorers and producers, the E&P firms, specifically the ones whose fortunes are most closely tied to spot crude prices.
Okay.
OPEC plus focusing on market share, plus maybe some lingering worries about oversupply down the line, it kind of puts a lid on price recovery. And that directly compresses cash flow potential for companies relying on those marginal barrels being very profitable.
But the E&P sector is huge. Why these specific names? APA Corporation, APA, Occidental Petroleum, OXY, and Marathon Oil, MRO. What makes them more exposed than, say, a supermajor?
It often comes down to operating leverage or their break-even costs. These companies might need a higher oil price to really thrive, compared to the giants like ExxonMobil or Chevron. So when prices look capped in the $60, they feel that pinch more immediately because their cash flow models might depend more heavily on prices getting above that level to fund future projects.
That makes sense. And that pressure on producers must then flow through to the companies that service them.
It does. Which brings us to the next category, oilfield services, particularly those focused on what's called deep cyclical capital expenditure, or CapEx.
So if producers are cautious about prices,
they get cautious about spending.
Yeah.
Especially on the really big long-term projects, what the industry calls long-cycle FIDs, final investment decisions, Think massive offshore platforms, things that take years and billions to build. Those need a strong belief in sustained high prices to get the green light.
And if those FIDs get delayed,
The whole service sector feels it. Pricing for rigs and services softens. Utilization rates, how often the equipment is actually working, can drop. The analysis suggests this could put pressure on major service providers like Schlumberger, SLB, Halliburton, HAL, and Baker Hughes, BKR.
and related to that, I assume, is the third group facing headwinds, offshore and high-cost drill contractors.
Exactly. These companies have very high operating costs themselves. They rely on something called day rate momentum.
Day rate momentum, what's at risk there for firms like Transocean, ticker rig?
The day rate is just the daily fee they charge to lease out their very expensive drilling rigs and equipment. To keep pushing those rates higher, you generally need sustained high crude prices. It's like a high-stakes rental negotiation. If the oil company hiring the rig thinks prices might weaken, they're less likely to lock in a long-term contract at a premium rate today. They might wait.
So a cautious outlook stalls those negotiations.
It can, yeah. It makes it harder for drillers to command top dollar for their equipment. The analysis mentions Transocean, Rig, Valaris, VAL, and also Deuce and Bobcat, DO, as potentially feeling this pressure.
Okay, so we have a pretty clear picture. Cost relief for some downstream, potential pressure for upstream and services. How are analysts suggesting people monitor this situation? What are the specific angles?
Well, for airlines and travel, the idea is to watch their stock performance relative to crude oil prices. See if they're outperforming when oil is stable or down.
The analysis mentioned pair trades, like long delta, short WTI.
Right. That's a strategy where you're betting that the benefit the airline gets from wider crack spreads, those refining margins, outweighs the direct impact of the crude price itself, and the travel demand stays strong enough to support it. It's a relative value play.
And for the refiners, what are the key things to watch?
The analysis points to specific metrics like 3-to-1 cracks. That's a common benchmark for refining margins based on 3 barrels of crude making 2 of gasoline and 1 of distillate, and also watching utilization rates, especially along the U.S. Gulf Coast. Ultimately, their upside really depends on demand for gasoline, diesel, jet fuel staying strong. If people stop driving or flying as much, stable input costs won't help if they can't sell the output.
Makes sense. And lastly, for the E&P and services sectors, the advice seems more cautious there.
Yes, the suggestion is to favor companies with stronger balance sheets, maybe those who have already locked in some prices using hedges.
And it warned against high beta names. What does that mean practically for someone watching these stocks?
High beta just means the stock tends to move more dramatically than the overall market, or in this case, the commodity price. If oil goes up 1%, a high beta E&P stock might jump 2 or 3%.
But it cuts both ways.
Exactly. It amplifies the moves up and down. So the analysis is basically saying maybe avoid that extra volatility right now. Stick with the more financially stable players unless or until crude prices show a very strong, confirmed upward trend, like reclaiming key moving averages on high trading volume.
So a lot hinges on where crude prices actually settle and perhaps more importantly, on demand.
That seems to be the key takeaway. This OPEC plus move sets a certain stage. But the real driver going forward, especially into next year, will be global demand. The market is going to be watching that Q1 demand data very, very closely. That data will really show whether OPEC Plus can actually make this price floor stick. If demand weakens significantly, then their strategy might face a serious challenge.
The ultimate test indeed. And just a reminder to everyone listening, the information provided here is not financial advice or a recommendation to buy or sell any assets. This information is purely the opinion of the author of the analysis we have discussed.